Hi everyone, I'm Tom Stelzer from Livewire Markets and I'm pleased to be joined today by James Gerrish from Market Matters to discuss what's been a very crazy time in markets and hopefully what comes next. James, thanks for being here.
Mate, great to be here, Tom, on a pretty nice Tuesday morning in Sydney.
James, obviously markets have been down, markets have been up, but what type of conversations have you been having with investors and how have they reacted to the recent turbulence?
So I guess our situation is a little bit different. We've got a digital advice platform, so we're writing to and communicating with a couple of thousand members each day. So, and some of those members invest funds with us and we manage those funds. So, we're talking to them on a regular basis, on a daily basis. So we're giving them the granular detail around what's playing out in markets, what our view is on the markets. And I think it's, in a time like that, that's a really important point, having a voice a voice of reason, a voice supported by data, if you like, that's speaking to members and investors on a daily basis. I think one of the important things as well is that markets have been incredibly volatile. We've been hit by trade tariffs that have been a lot more aggressive than anyone thought they would be. You've got to anchor it to history. So obviously there hasn't been a lot of instances where tariffs have been in play in history, but if you think about more market indicators that are more universal, so and you anchor that to data. So if I look at the volatility index, for instance, it's a widely used measure of fear in the market. When that spikes above 50, as it did at the start of April, the returns to the S&P 500 are positive on a 12-month basis 99% of the time. So if we're putting out those sorts of data-supported statistics, overlaying our views of the market, we tend to calm those people reading our notes, calm those people investing with us. And the clear message is you've got to look through short-term volatility, and that's how medium to longer-term returns are generated. Running for the exits when these sorts of things happen is not the way to go. And I think the recent bounce in the market has certainly shown that to be true.
Yeah, I mean, as you said, obviously we've had a decent bounce. The ASX itself has probably outperformed a lot of the global markets, and I think it actually finished April in the green, which is rare if you look around the world. What do you think has kind of led to that recovery?
So, I mean, markets that drop quickly tend to recover quickly. So, the S&P 500 peaked all-time high 19th of February. By the 7th of April, it was down over 21%. That's quite a significant drop in a short amount of time. From the 7th of April, and we're about a month from that date now, the market's recovered over 17%. So big falls generally lead to really, big, sharp, quick falls generally lead to big, sharp, quick recoveries. I think in the context of Australia, I think benchmark composition has probably got some element to play here. The US market is obviously more growth focused. We've had a growth scare. Tariffs are a negative for economic growth, particularly in the US. And I think the composition of Australian, the benchmark being a little bit more defensive has served it well. We've also got more correlation to Asia and Europe. And then if you think about trade policy that's being rolled out, so in my view, this is an absurd policy. So if you think about the big loser here is going to be the US if this continues on the path that it's going. So 40% of goods imported into the US from China are intermittent goods. So that means they're going into some other production process to generate goods over in the US. What Trump has done here is that he's put basically an embargo on importing Chinese goods that go into US produced things. That's going to hurt thousands of American companies. They can't go and suddenly manufacture overseas. So if I stand back and think about, is this a credible policy? Is this going to be a policy that will make America great again? I simply don't believe that to be true. Deglobalisation, protectionism is not good policy. So therefore it probably is a strategy. If it's not good policy, it has to be a strategy. So look, I think we're at the vortex or we have been at the vortex, and we're seeing cooler heads prevail, an easing of rhetoric from the US. And I think if you think about Australia, then we've got some exposure to Asia. We're heavily exposed into Asia. If you think the US is going to be a loser, then potentially China could be relatively a winner in this trade debacle. and then Australia can be used as a proxy for that. So I think we're starting to see that play out here in Australia as a relatively stable market to invest in that's reasonably defensive as well.
Yeah, and so obviously you've said there, the USA are likely going to be the loser here. China might be the beneficiary. Australia might be a second order beneficiary. Where do you see the opportunities, I suppose, in Australia from the backlash to the tariff?
It's really uncertain at the moment around who will be the winners and losers. So the US, it depends how hard they continue to go on this, and it's still an evolving feast. And no doubt there's going to be further negotiation to come and a softening, if you like. So, but here in Australia, I'm pro-Australia. I think we're in a really good position to benefit from the improving trade outlook. So I think we've had the big shock. We've had the recovery. Markets are up circa 17% from the lows. So I think from a timing point of view, I think we're not going out there and putting new money into equities right now. But from Australian context, I think if you get more information, more clarity around the economic impact of new trade policy, so will the US go into recession? It might go into a technical one. We don't think it'll go into a deep contraction. You've got a situation where defensives in Australia have run really hard. So my inclination is to be moving more out of those defensive areas into the more cyclical areas. So positioning for what comes next. So ultimately, the US needs to grow. That's the playbook here. US growing is good for global growth. China is stimulating. That's good for global growth. So we need to get over this trade war hump. But once we do, I think the growth outlook starts to look better.
And I mean, I think you've said obviously after the sharp falls come the sharp rises. The markets, especially in Australia, bounce back really well. Do you think investors have kind of missed the boat on that recovery?
Yeah, it's a really good question. So markets, as I just said, they're up 17% from their lows. Probably not adding new money to stocks right now. But one thing that investors can look at is that the structure of a market when it pulls back after a good run. So obviously the rally has been really aggressive, and that's a really positive thing from a market's point of view. So we need to now sit back and see whether this is a dead cat bounce, as they say, or we're going to go into a more constructive pullback consolidation area. So I look at charts. We look at price action on individual stocks, indices, commodities, etc. And what we want to be seeing now is that after a really strong rally, we have a consolidation in the market. We can have weakness, but it's not aggressive weakness. My view right here, right now, is that the nature of the rally, how aggressive it was, implies that this isn't a dead cat bounce, that it is something more sustainable, and that would dovetail in with better rhetoric coming out of the trade negotiations between the US, the rest of the world, but the main game still is obviously China. So from a near-term point of view, you want to see a consolidation in the market, not a deep pullback, and then that to me sets up the prospect of going towards new highs again, which are not that far away now.
Yeah. I mean, if you zoom out a bit and you look at the chart, it does look a bit more bullish than maybe I think people thought a couple of weeks ago.
Yeah, if I've learned something in markets over 20 years being in here is not to shy away from market volatility. 20% corrections happen more often than people expect. And there's those people in the market, and to your first point earlier on around how individual investors approach the market, it's really interesting. Some people, the majority of people, lean into volatility weakness. Some people get a little bit concerned about it. I think after a period like this in the market, it's a really good strategy to go back and look at the composition of your portfolio, the asset allocation you've got in your portfolio, to see whether or not it's suitable after were you too nervous? Did your portfolio experience too high a volatility? If I look at our growth strategy, it had a tougher time, there's no doubt about that. If I look at our more defensive income strategy, it had a maximum drawdown of 4% during the period. So you think about how portfolios perform in a time like this, and whether or not you've got the right portfolio structure. I think that's what we're here to do is guide investors on what sort of asset allocation, portfolio structure they should be having.
And I mean, I think you mentioned it just before, you're not necessarily adding to positions at the moment, but do you have some, cash on hand and still looking for opportunities, or are you fully invested?
So we've got different portfolios, different cash levels, but generally between 5 and 10% across the various portfolios. What are we doing in markets around that? I think our playbook into a period like this is not necessarily going and buying the cheapest things that have really been kicked to the curb. There's a lot of high quality stocks that have pulled back that have got tailwinds in the industries that they're operating. They've been executing well for a long period of time, and they've had pretty meaningful share price corrections as money has run for the exits. People have panicked in this market decline. So they're the areas we're really focusing on.
Do you have any names there?
I mean, if I go through what we've done in portfolios, we've bought Hub24, for instance. That's a stock that moved from 90 to $50. That's a really big move in a high quality growth stock that's got structural tailwinds. Aristocrat Leisure, another one that's pulled back. Pinnacle, Sandfire Resources, great tailwinds in terms of copper, but it was down 30% in a heartbeat. So you still don't need, so say you go into this period and you don't have the elevated cash levels. We didn't have as much cash as we really wanted to in our growth strategy. So you've got to be moving within the portfolio. So an example of that would be, so we had a reasonable position in BHP. So to buy Sandfire, we're trimming our position in BHP to allocate into a higher beta name that's been sold down more, that's got a more pure exposure to a theme we like in copper. So there's certainly ways around how active management adds value. And I think if we look forward, I think we're going into an environment where active management, talking my own book, and there's no doubt about that, but active management will be have a better environment. So if you think about, we've just come off an election, so ALP stonking win in the federal election. That's going to have ramifications for changes in superannuation, etc. There's going to be a likely push through a taxing of unrealised capital gains in super for balances over $3 million. If you think about how ETFs operate, they're owning more of the stocks that have run hard, that have got the most capital gains within them. CBA would be an example in terms of that. So as I look forward, I think active management is going to have a really strong 12, 24 months. I think there's going to be plenty of opportunity in the market. And I think there's, some of the defensive areas have probably held up really, really well, and some of those could be used as funding vehicles. So, if I look at things like, and we own some of these, Dalrymple Bay Infrastructure, DBI, you've got APA Group, Wesfarmers, Woolies, a bunch of others, APA, Transurban, all of these. If you look at those charts, you wouldn't know there's been a market correction of 20%. So these outperformance has been stark. So perhaps it's time to start looking, and we get more clarity around trade tariffs, etc., trade policy, then trimming of those defensive areas to move more into the cyclicals, I think, is our roadmap.
Yeah. And you mentioned looking forward, obviously we've got the McQuary conference coming up and, a mini reporting season, I suppose. What are you keeping an eye on there?
Yeah, McQuary conference this week. There's going to be, obviously, I think there's probably more chance of more bad news than good news coming out over the next week. Confession season, so you've got companies that are probably, if they've been struggling over the past 6 months or so, they've now got something to blame on weaker earnings. I think that'll probably be the position taken by a lot of companies out there. So to me, I'm a little bit cautious on the company front, but the markets are thinking that way. So I'm not alone in that thought. So I'm always one to shy away from the consensus thinking and potentially try and go against the grain of consensus thinking. I know that's not a great answer to the question. I think there's probably going to be more bad news than good, but I think the market's expecting bad news. We saw it in the, one example this week we've had, or in the last couple of weeks, we've had Flight Centre downgrade and we've had corporate travel downgrade. We're starting to see broker upgrades on corporate travel because the market's been preempting this downgrade. So when the bad news is out, then it can open up opportunities in stocks.
Yeah, I was at a conference last week and someone mentioned to expect probably more fireside chats and less slide decks at the Macquarie conference this week, because I think, as you said, there's going to be, couple of downgrades there, and that people are going to have those more kind of informal conversations about their vision than the hard numbers. But as you said, if the market's expecting that, then maybe there won't be too it'll be a pretty soft landing coming back down.
Yeah, well, the market's forward looking, right? So numbers are the historical numbers are one thing, and we anchor they're important, but it's what comes next is really the key from an investment standpoint. I don't really I want to hear about what numbers have been delivered, but the main thing is around the outlooks. That's what we really care about, and thinking about the next 6 to 12 months and beyond, not the last 6 to 12 months.
Yeah, I mean, touching on probably, I suppose, arguably the biggest recent winner has probably been gold. And what do you see the kind of outlook there being for the next 6 to 12 months, and how are you guys positioned around that?
Yeah, I think I'm a long-term gold bull. I think what's played out from the Trump administration in terms of tariffs has made the US dollar less appealing. I think it's made US Treasuries less appealing from a safe haven perspective, and that plays into gold's hands. I think from a short-term point of view, I think it's a overcrowded trade. I think it's gone too far on the upside. I think it's susceptible to, you could easily move down a couple of $100. I know it was, we're at 3,200 an ounce or slightly above this morning. To me, it's a very crowded trade. We've pared back the majority of our gold exposure, but if it was to come back more towards 3,000, 3,100, then we'd be increasing. I just get nervous around crowded trades, and I think gold is universally a crowded trade. You think about what the US dollar's done. The US dollar index has moved from 110 down to 100. That's a really strong tailwind for US denominated gold. So to me, I'm not there for now, but looking to buy weakness.
And obviously you mentioned it being a crowded trade there. Are there any other crowded trades that you're kind of a bit wary of at the moment?
I think that I pull back into the defensives that I was just talking about. I think that the defensives have naturally attracted a lot of money into this market volatility, and we've still got a lot of uncertainty how this plays out. So probably the catalyst to sell defensives and buy cyclicals were a bit early on, but I think that is a crowded trade. I think it's been easy to put money into defensives. They've done particularly well in the face of volatility. I think the harder trade, and I think from an investor standpoint, taking the harder trade off often pays off. Taking some money out of defensives and using it to buy cyclicals is probably the way I would play it.
And just a final question. I think you've said you're cautiously bullish on the ASX at the moment. Where do you see it end of year?
An index target, hey? So I think there's going to, 8,600, above 8,600 is the all-time high. We've been writing in our daily reports, we think the market will test its all-time high by Christmas. So what's that, another 500 points on the upside from this current level for the ASX 200. So I'll continue to hang my hat on that.
Well, James, that's all we've got time for. Thanks for joining us today.
Thanks for having me, Tom.
Thanks everyone for tuning in. There's plenty more videos like this on our YouTube channel. Be sure to check it out.